Hey folks, I am getting insanely rich in this stock market and I hope you are as well, but more particularly me. Why? Because I YOLO'd a bunch of money yesterday on GameStop, which if you hadn't noticed in after hours is trading up hundreds of percent, over $200 thanks to those Wall Street bettors out there. And I'm just kidding, folks. I never actually bought into GameStop, but oh my God, you couldn't even keep up with the forum conversation, which was just insane into close on this market today, guys. But the reason we're all still getting rich, baby, is you don't got to make crazy spec plays in this market. You just got to hold foundational stocks, which a lot of us were sitting on the edge of our chairs waiting for earnings to come out today to kind of set into motion what's going to happen across the different sectors of the market. And baby, do we know? And we are getting rich because now we know, thanks to Microsoft, which just came out with earnings and after hours here, guys, and it popped the stock up huge, like a whopping 6%, which doesn't sound like much, but with a $1.6 trillion market cap, guys, these companies are trading like growth stocks, and it is unimaginable with how many people were saying tech is overvalued. Tech is overvalued. I'm selling my tech. Well, yet again, guys, you don't bet against the conglomerates with a 37 PE, now 100% justified for Microsoft, because taking a look at these earnings, revenues are $43.1 billion, an increase of 17%. Those numbers, let me say that again, $43 billion. Do you know how stupid crazy that is for one quarter? Now, basically, the diluted earnings per share, what they ended up with, put in shareholders' pockets, baby, was $2.03 on that EPS, up a whopping, are you ready for this? Like, think about this. Are you ready for this? 34%. 34%. Microsoft is still a buy, guys. I don't know what to say about it. And if that wasn't enough to put a bloody cherry on top of the cake, why is nobody talking about Microsoft getting involved in space? I mean, if Microsoft was trading at like the PE ratios of something like Virgin Galactic, this thing should already be going to the moon. I mean, Cathie Wood will likely be adding Microsoft to the space ETF that they are going to be launching sometime in the future. And if they don't, I wouldn't know why, because on their website, guys, Azure Space partners with deep expertise to new ventures, because Microsoft is partnered with SpaceX, guys. I mean, read this. Microsoft is moving into the final frontier with Azure Space, a new initiative that will deliver innovation to serve mission needs of the space industry, and collaborating with industry leaders to bring new and enhanced offerings to organizations across the public and private sector here, folks. So not only are you getting these absurd growth earnings on these massive, huge market cap companies that sit in the S&P 500, I mean, you're also getting the growth that all these little growth companies are trying to just breach. And I mean, Microsoft can't lose, guys, because if they do lose, they still have billions and billions and billions of dollars, and you're not even going to see the impact on the bottom line until it does work. This is some like insane stuff. So if you do not own these companies, which I've told you time and time again, just get your exposure to them, whether it's through the QQQs, which represents the NASDAQ 100, or heck, even if you own your VOOs or your SPYs, those S&P 500 indexes of the world, but at least the top 10 of those, which make up 20% of the entire ETF, which doesn't make sense because there's 500 companies and really 10 of them make up the vast majority of it. But heck, at least you get exposure that way to these beautiful conglomerates here, folks, at which currently my Microsoft position, which I just can't bring myself to ever trim here, I hold 60 shares at $103 a share, guys, trading up 125% into close. That'll be 130, 135% by tomorrow. Just crushing it on this position, which is going to set it into motion, telling us how the rest of the tech industry is likely to report. And considering a lot of this is due to the cloud computing, that is a good sign for Amazon. That is a good sign for Apple, which, keep in mind, we get Apple and Tesla tomorrow, along with, I think at the opening bell, we're going to get to hear from the Federal Reserve Chair, Jerome Powell, because that's how we all feel, baby. We're just printing like the Federal Reserve. So I really, really, really hope you guys are not stacking cash. You should have your emergency fund ready. Keep some emergency fund for sure. But oh my God, guys, keep buying stocks. We're all getting rich. My portfolio, it's going to cross 300,000 here before summer. I can feel it. I can feel it, baby. But just taking a look, guys, let's talk about the safer place. Heck, you don't even like tech. Dividends. All the bloody way. Talking about Johnson & Johnson here, which into the earnings, which was just before the opening bell, we saw that it bumped up 2.7%, guys, which over the last 5 days is where we've seen most of the growth leading into earnings. This one, not a growth company. you're still paying fair value for it, in my opinion, but every dividend investor has to own this one, guys. And just taking a look, their 2020 fourth quarter sales were about $22.5 billion, reflecting a growth of 8.3%, of operational growth at 7.1%, and adjusted operational growth around 7.3%. Nothing too crazy, but let's just take a look at the 12-month end, because this is going to show us what the entire year of 2020 looked like on the healthcare front, which kind of blows my mind that they're seeing a huge decline in basically medical device sales, which is a 30% segment of their total revenue, supplying like all that surgical equipment, which as we know, a lot of people had to put off their surgeries for 2020. But taking a look, guys, for 2020, we've seen only a 0.6% increase on the reported sales. So again, when we're talking about stabilized dividend income in the midst of one of the worst experiences to the financial markets and the markets in general since the 2008 financial crisis, damn, this is not that bad, guys. This is pretty good here. But the real impressive thing was net earnings. They managed to get up to 2.7%. So not like we're going to see any major dividend increases down the road or anything, but at least we know our income is stable and the healthcare market is still proving resilient under this conglomerate that kind of gives us a bridge between, it's like an ETF, guys. You basically get your consumer staple brands with things like Tylenol, your medical equipment, and then your pharmaceutical drugs. So can't go wrong ever with J&J. Unbelievable stuff here, guys. Taking a look at my position as it sits right now, I'm glad I picked up when I did all last year. Currently hold 85 shares, average cost $140, trading up 20%. Even still, up 20%. Who says you can't get decent growth from these boring companies that just pay juicy dividends, guys? Finally, the only company that I want to mention just one more time here, because I briefed over it yesterday, but I think it's important to recognize as a dividend primary focused investor, which I know in these speculative growth days, it's hard to be a dividend investor, guys. Got to mention Kimberly-Clark, because this one, even Jim Cramer was beating into the ground leading into its earnings. And this one's been a lot more volatile, a lot cheaper than J&J in my opinion, but also slaughtered earnings, guys. Fourth quarter 2020 net sales, $4.8 billion, an increase of 6% compared to a year ago prior, including organic sale growth of 5%. But that isn't what got investors excited. Me particularly, because I don't ever plan on selling these companies. These are ride to the grave type companies, was the increase on the dividend, guys. They increased the dividend by 6.5%, up to $1.14 from $1.07. And that's not the best part. The best thing, the trifecta of super greatness, guys, is not only good earning reports in the midst of a pandemic, like really good earnings, because trust me, you could be in the airline industry right now, but put the earnings aside, we're also getting share buybacks, baby, which if you don't understand how share buybacks work, the company basically buys more of their own company off the public market. So when they go to post their earnings, those earnings get projected, the EPS number is directly divided out by the shares outstanding. So if there are less shares on the table, that means the EPS number is going to be bigger, which makes you, the shareholder, have an even larger chunk of the pie of the company. So it's like the company's giving you a bigger piece of the pie. They're giving you more cash. I mean, it's just cash on cash on cash on cash. Putting all of this awesomeness aside, guys, again, tomorrow we got some big earnings. Once we get through the end of this week, we can all take a breath and step back. I want to throw in as well, guys, it's nice to recognize when you're holding terrible companies. GEO Group got slaughtered today. I'm sorry for anybody that's still holding it, but I did send out a warning that, yeah, even though the technical fundamentals are incredible on a company like that, guys, it's just that we got a president that's going to beat it into the ground. And unfortunately, Biden today announced that fighting the private federal prison system and start mitigating the government away from using their services. Bad news on bad news for that company. I'm so glad I got rid of it. But if I cross my fingers here, guys, and things actually just continue on the route they're going with the stocks I have, there is no reason that my portfolio shouldn't be sitting somewhere over $275,000, I'm hoping, by the end of next month. I'm crossing my fingers. You can stick around. I will always do my portfolio reveals at the end of every week. So yes, consider subscribing. Stay cool. Stay awesome. I look forward to catching you tomorrow.